Many financial analysts recommend buying the S&P 500, Nasdaq, or Dow Jones, but you probably notice that these do not trade. They are simply an index, meaning their only purpose is to replicate what the description is following. An index is simply a set of rules that decides which assets are included and in what proportion. For instance, the biggest 500 US companies or the 100 greatest tech businesses. If you were to buy any of these, you do it through an ETF or exchange traded fund. At its core, an ETF is a simple idea wrapped in a modern structure. Instead of choosing individual companies, bonds, or assets one by one, a person has access to a single product that already contains many of them. It is a basket of goods, like a fruit salad. The intellectual foundations of ETFs comes from academic research rather than Wall Street intuition. Several Nobel Prize winners in economics, such as Harry Markowitz, William Sharpe, and Eugene Fama, showed that risk is not just about how volatile a single asset is, but about how assets interact with each other, what it's called in statistics covariance. To understand why this changed everything, consider the capital asset pricing model, or CAPM, developed by Bill Sharpe. It split risk into two categories: systematic risk, the market peril that affects everyone, like a war or a recession, and idiosyncratic risk, the danger that the specific CEO makes a bad decision or a factory burns down. The math proved that the market does not reward you for taking idiosyncratic risk because it can be diversified away for free. In other words, if you bet on one company and win, you got lucky. If you bet on a whole market and win, you were compensated for the inherent risk of capitalism itself. This is why the ETF is often called the democratization of Wall Street. It gave the average person the same mathematical advantage previously reserved for the largest endowment funds in the world. Their work demonstrated that diversification is not a slogan, but a measurable way to reduce unnecessary risk. It's a free lunch, meaning everybody benefits. Later research showed that over long periods, very few professional managers consistently outperform the market after fees. ETFs are a practical application of these ideas. They do not try to be clever, they try to be robust. Most ETFs follow an index. There's no discretion and no intuition involved. If a company grows, it adds weight. If it shrinks or disappears, it loses position or is removed. By buying an ETF, an individual accepts that they do not know which company will be the winner in the next decade, but that economic growth, productivity, and human activity as a whole will likely continue in some form. This acceptance is not pessimism, it is realism. From a personal finance perspective, ETFs solve a practical problem. Most people save gradually over many years with limited amounts each month. They cannot diversify efficiently by buying dozens or hundreds of individual assets. ETFs allow diversification from the very first dollar invested. They also tend to have low costs, which is critical. Fees compounds negatively over time just as return compound positively. A small annual cost difference can mean a large delta in retirement outcome. To put numbers to this, the SPIVA or S&P Indices versus Active Scorecard consistently shows that over a 15-year period, nearly 90% of active managed funds underperform the benchmark. This isn't necessarily because the managers are bad, but because the arithmetic of active management is unforgiving. If the market returns 7% and a fund manager charges 1.5% in fees, they must generate 8.5 just to break even with the damn ETF that costs 0.05%. Over a 30-year career, a $100 investment growing at 7% becomes roughly $760,000. If you lose just 1% more to fees, the final number drops to roughly $570,000. That small 1% fee effectively confiscated nearly $200,000 or 20% of your total lifetime wealth. Risk still exists, and it must be clearly stated. ETFs do not protect against market crashes, recessions, war, demographic decline, or long periods of stagnation. If the global economy performs poorly, diversified investors will also feel it. What ETFs mainly reduce is avoidable risk, the perils that come from betting too much on one company or country or one idea. In that sense, ETFs are not about maximizing returns in the best case, but about increasing the probability of a tolerable outcome in most cases. This is especially relevant when thinking about pensions. Many public pension systems around the world are under strain due to aging populations, lower birth rates, and fewer workers supporting more retirees. In many countries, future pensions will replace a smaller portion of income than in the past, or will require higher taxes, later retirement ages, or both. This is a matter of the support ratio. In the mid-20th century, many developed nations had a ratio of about 5 or 10 workers for every one retiree. Today, many parts of Europe and East Asia, that is heading towards a 2-to-1 or even lower. This makes the old defined benefit pension a mathematical impossibility without massive tax hikes. ETFs represent a shift from a collective promise, which can be broken by politicians, to individual ownership, which is backed by global corporate productivity. By using an ETF, an individual is no longer relying on the tax base of their specific city or country, but on the cash flows of the global economy. ETFs have become a central tool in private retirement savings because they allow individuals to participate in long-term economic growth without needing constant supervision or level expert knowledge. They are not guaranteed, but they are one of the few scalable solutions available to millions of people at once. At a deeper level, exchange-traded funds represent a shift in mindset. They assume that uncertainty is just permanent, that forecasting is limited, and that discipline matters more than brilliance. They reward patience rather than activity. For most people, the real challenge is not finding the perfect investment, but staying invested through good and bad times, through thick and thin, continuing to save and avoiding decisions driven by fear or excitement. ETFs do not remove this challenge, but they reduce the number of ways in which a person can make a catastrophic mistake. You can think of an exchange-traded fund as a financial tool designed for non-financial humans. It accepts that citizens have jobs, families, and lives outside the market. It accepts also that most people cannot and should not try to outsmart professionals or predict macroeconomic events. Instead, it offers a way to align personal savings with the long-term evolution of the economy, while keeping costs low, rules clear, and decisions limited. In personal finance, this combination is not just glamorous, but it is powerful. Although the evidence is strong that even for those who dedicate their life to investing, ETFs are the ultimate obstacle, being almost impossible to beat it continuously. Just to conclude, let me mention that there's a chance that you can beat the market. You are pretty much against the odds completely, but there are some situations in which retail investors outperform institutions due to lack of fund restrictions, time horizons, and size. So in the end, it's not a fully free lunch. You're just being rewarded for those costs that you are not bearing. A 10 billion pension fund cannot buy a small cap stock without dropping the price up 20% before they even finish their order. They are trapped in the biggest stocks. You there with 10,000, 100,000 or $1 million. You are invisible to the market. You can move in and out of niches, hold for 20 years without a quarterly board meeting breathing down your neck, and ignore the benchmark hacking that forces professionals to buy overvalued stocks just to avoid looking different from their peers. Your advantage isn't that you are smarter than the algorithm, it's that you are not playing the same game as the algorithm. Well, that's it for today. I appreciate you watching the entire video. If you like it, subscribe and hit the like button. If you did not enjoy it, please tell me in the comments why so I could fix it for the upcoming videos. My name is Fausto Catalano and I'll see you soon.